We're jumping straight into Robinhood today. Everyone is watching the price action, but the real story is the massive pivot from a trading app to a full-stack financial super app.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Okay, so before we really get into it, if you want to keep getting these simplified breakdowns, just do us a quick favor and hit that subscribe button. Give us a like, too. It genuinely helps.
It really does.
Now, we have a ton of research here to get through: earnings reports, analyst notes, some pretty wild rumors. But let's start with the big one. That stock chart in 2025.
Yeah.
I mean, it was practically a vertical line, a surge of something like 230%.
It's been a wild ride. But, that's the key point. If you just look at the chart, you might think, okay, here we go again, another meme stock rally.
Right. The retail crowd is back.
Exactly.
Yeah.
But the fundamental business that's underneath Robinhood today, it's almost unrecognizable compared to the company from, say, 2021. The whole story has changed.
That's the perfect way to put it. I think so many people still have this picture in their head of Robinhood as this, gamified app for trading joke coins.
And people are still doing plenty of that, to be fair.
Oh, for sure. But let's dig into what some of the analysts are calling this money machine transformation. I mean, the headline numbers for Q3 2025 were just jaw-dropping. Revenue hit $1.3 billion.
Which is a staggering number when you put it in context. That is a 100% increase year over year.
They doubled their revenue.
They literally doubled it.
Yeah.
And in the world of mature fintech, you just don't see that kind of growth unless there's some huge acquisition. This is mostly organic.
Okay, so doubling revenue is great, but we've seen a million tech companies double their revenue while just, lighting piles of cash on fire. What about actual profitability? Because that's usually where the story falls apart.
And this is the part that actually matters. This is the big difference from the old days. They're not just growing, they're keeping the money. The turn to profitability has been, frankly, aggressive.
So net income is positive now.
It is. We saw it hit around the $1.4 billion range in recent reports.
Yeah.
But the metric that really jumped out at me was the incremental margins.
All right, let's unpack that. Incremental margins sounds like a term designed to put people to sleep. But in this case, why is it so important? What does it actually tell us?
It's all about efficiency and scalability. They reported incremental margins of around 81%.
81.
Yep. And in plain English, that means for every new dollar of revenue they bring in, they're keeping about 81 cents of it as profit before some of their fixed costs.
Wait, 81 cents on the dollar? That seems incredibly high.
It's massive. I mean, think about a normal business, right? A car company. To sell more cars, you have to build more factories, buy more steel. Your costs scale with your revenue.
Sure.
This is pure software leverage. The platform is built. Adding one more user costs them almost nothing. So as they grow, the profit just explodes. They built the machine, now they're just feeding it.
And they are definitely feeding it. I remember the biggest knock on them used to be, oh, it's just trading fees. If people get bored, the business dies. That was the whole bear case for years.
And that argument is getting really hard to make now. It's becoming obsolete, really.
How so?
The data we're seeing shows they have a thing like 9 to 11 different business lines. And each one is already generating over $100 million a year. This isn't a one-legged stool anymore.
So what are the big ones there? I assume crypto is still making a lot of noise.
Oh, crypto is the loud engine, for sure. Revenue there was up 300%, which, makes sense with the market cycle. But honestly, I'm more interested in the boring stuff.
Boring stuff.
The subscriptions. Their gold service just hit 3.9 million subscribers.
And that's the paid tier, right? You pay a monthly fee for extra features.
Precisely. And think about that. Trading revenue, it's volatile, it goes up, it goes down. Subscription revenue, that comes in every single month, rain or shine. That creates a real floor for the business.
Plus the interest income. With rates being higher, they're making a killing on the cash just sitting in accounts. It feels like they're trying to build a moat so you never, ever leave the app.
That is the entire strategy, platform. I mean, it feels like a new Robinhood killer app launches every week. And yet, here they are with 26.9 million funded customers. But it's who those customers are that really matters.
The younger demographic.
Exactly. They have basically captured the millennial and Gen Z market. And the goal isn't just to be their stockbroker. It's to be their #1 wallet share, your banking, your retirement, your crypto, all of it.
That network effect has to be incredibly sticky.
It is. Once your whole financial life is on one dashboard, the idea of switching to a competitor just becomes a huge pain.
It's the super app dream, and they keep rolling out features to lock you in further. I was looking at the notes on something called Robinhood Legend. What is that?
Ah, yeah. That is a direct shot at the serious brokers. For years, the knock was that Robinhood was a toy. It was too simple, confetti, you know.
Right, you'd graduate to a more serious platform.
Legend is their answer to that. It's an advanced, detailed desktop platform for serious traders. They're trying to stop that churn.
So they hook you with the easy app, then give you pro tools, so you never leave. Smart.
It's the retention play. And then for the complete opposite user, the passive investor, they have Robinhood Cortex.
The AI assistant.
Right. So they're covering both ends, the hyperactive trader and the set it and forget it investor.
And you can't forget the banking, offering 4% APY on cash. It's just hard to leave when your savings earn more there than at a big bank.
It just increases the switching costs. You have your direct deposit, your IRA, your crypto.
Yeah.
They're locked in.
Okay, now this is where things get really interesting. We have to talk about the rumor mill. There are some headlines floating around that are, let's call them speculative, but they'd be huge if they pan out.
You're talking about the 24/7 trading news.
That's one. The reports say they're partnering with a firm called Talos to potentially allow trading around the clock. Weekends, too. What would that even do?
It would be a game changer. It aligns them perfectly with the crypto world, which is already 24/7. There's a whole generation that just doesn't get why the stock market closes at 4 p.m. on a Friday.
It feels ancient to them.
It does. If Robinhood brings that always-on market to stocks, it just drives more engagement, more volume, keeps the casino open.
Okay, but what about the other things? I saw a report about the CEO pitching Trump accounts. Something about administering government accounts, and even wilder, trying to get retail access to the SpaceX IPO.
Now, we have to be super careful here. This is all speculation, but just think about the marketing of that for a second. If Robinhood becomes the only place for a regular person to get a piece of an IPO like SpaceX,
That's the holy grail. Normally, you have to be a millionaire client at a big bank to get that kind of access.
correct. If they unlock that, it completely validates them as a platform that gives the little guy access to Wall Street's private club. The user growth from that alone would be astronomical. Sign up, get a shot at SpaceX. That sells itself.
It's definitely exciting stuff, but we have to look at the other side. This can't all be rocket ships. Let's talk about the bear case. Because after a 230% run, you have to ask, is it just too expensive?
That is the #1 question. And looking at the valuation metrics, it is rich. The stock's been trading at what, 51 to 60 times earnings?
50 to 60 times. Wow. That's like high growth software territory, not a financial company.
Exactly. For comparison, a traditional broker like Schwab trades in the 8 to 15 times range. So you are paying an enormous premium for that growth.
The stock is priced for perfection then.
That's the danger, 100%.
Yeah.
At 60 times earnings, you can't just have a good quarter. You need an amazing quarter. Every single time. Any tiny slip up, any slowdown, and the stock could get cut in half. The high wire act.
And speaking of people who might think the price is a bit high, I saw some flags about insider selling. The chief legal officer, Daniel Gallagher, sold off a decent chunk.
He did. About $3.65 million worth near the highs.
That's not a small amount.
It's not.
Yeah.
Now, to be fair, it was a pre-planned sale, a 10b5-1 plan. So it's not like he just woke up and panic sold. It's all scheduled in advance.
Sure, there's legal cover, but the optics.
The optics matter, absolutely. When insiders are cashing out millions after a rally like that, it sends a signal. It doesn't scream, this is going to double again next month. It suggests they feel the price is, at a minimum, fair.
It raises an eyebrow for sure. And then there's the old dependency issue. We talked about diversification, but 55% of their revenue is still from transactions.
And that's the core risk that just won't go away. They are still incredibly sensitive to retail sentiment. If we enter a long bear market, or if people just get bored of trading, that revenue stream dries up.
So they need excitement. They need volatility.
They thrive on it. A flat, boring market is terrible for their business. They need action.
And we can't ignore the regulatory side, that $2 million settlement about order routing.
Right, the whole payment for order flow debate, that's still a huge engine for them. And there's always a risk that regulators in D.C. could decide to change the rules on that or on crypto. That regulatory cloud is always kind of hanging over them.
So, high valuation, regulatory risk, and a business that relies on market vibes. It's a risky combo. Let's look forward. What should we be watching over the next, say, 30 to 90 days?
Okay, number one is earnings. Q4 2025 results should be coming up. The metric to watch isn't just profit, it's the growth rate. Can they keep up that 45–50% revenue growth?
Or are things slowing down?
Exactly. If they guide for slower growth, that high valuation could come down to earth very, very quickly.
And what about their M&A? They've been buying companies, right?
Yes. Keep an eye on the closing of the WonderFi deal. That's their big push into Canada. And also any updates on the Bitstamp integration for their global crypto plans. They have to prove they can actually integrate these companies without messing up their margins.
Okay, and then the macro picture. Interest rates. How does that affect them?
It's a double-edged sword. Remember all that money they make on cash sitting in accounts?
Yeah.
Well, if the Fed starts cutting rates, that free money, their net interest income, goes down automatically.
So lower rates actually hurt them.
In that one specific way, yes. So if rates fall, they need trading volume to pick up the slack. A world with lower rates and lower trading volume would be the nightmare scenario for them.
And I saw one last thing in the notes. Prediction markets.
Yeah, it's not so niche anymore. Think betting on elections, sports, things like that. Management is expecting volume there to triple. It's another one of those revenue streams that a traditional bank just would not touch.
So let's wrap this up. Putting it all together, the research feels overwhelmingly positive. I'd give the bull case here a solid 9 out of 10, even with that valuation.
I think that's a fair assessment. The transformation is it's undeniable.
The elevator pitch is pretty simple. Robinhood has graduated. This is not the gamified meme app anymore. It is a legitimate financial powerhouse with a massive war chest, $4.3 billion in cash.
They have the cash, they have the users, and they have the tech. The pivot to a super app is real. They survived the crypto winter, they survived the slump, and now they're on the attack.
But here's the final thought I want to leave everyone with. The question isn't really if Robinhood can survive anymore. I think it's, can the traditional banks survive? Can they survive an entire generation that prefers to do everything, banking, AI investing, all of it, on a single app on their phone?
That's the billion-dollar question, isn't it? Can the old guard adapt before Robinhood eats their lunch?
And that is the lowdown on Robinhood. If you enjoyed this breakdown, don't forget to subscribe and hit that like button. We'll see you on the next episode of The Easy Money Show.
Thanks for listening.